Today, we're going to be talking about the free lunch on Wall Street that everybody knows about, but everybody seems to get wrong, or a lot of people tend to get wrong, and that's diversification. And one of the biggest problems that we see is people will come in with portfolios and they'll be showing us their portfolio and they'll have like 7 or 8 funds. This happened just the other day. And the funds all look different. They have different names, they sound different. But then when we dive underneath the hood, we see that they own the same securities or they actually correlate really high together. So we're going to talk a little bit about how we can solve that problem and become better investors. So JP, before we dive in a little bit more, tell me a little bit about your initial thoughts and experience with diversification and why it's important.
I always go back to this. You only want to take risk as an investor that you get paid for. So you do not want to take any risk for which you're not expected to get compensated. And by compensated, in our business, we mean returns. So I want returns for any risk that I make, right?
Yeah, that's true. Yeah. That's a good point. We want to be compensated for risk. I was thinking about why diversification is so important, and I just have a list of things, and probably the first one is just a smoother ride. You know, I mean, when you have the right diversification, investors will get a smoother ride, and that really evokes less emotion, right? So people will tend to stick with their investment program and tend not to bail out at the wrong time. That's the first thing I thought about. And the other thing I thought about was, you know, you can actually have better returns if you have lower risk, right? If you have better diversification. When you think about it, there's all these studies out there, academic studies that say, if you look at the CAPM model or capital asset pricing model, it says that the higher the beta, the higher the rate of return. But then we backtest that, and we actually see that you actually have better returns with lower beta stocks sometimes, and a lot of the times. So, and the reason why is because it takes more, the mathematics of a percent drawdown is not the same as a percent going up. So you have to actually rise a lot faster when you're going up to recover from big drawdowns because of high volatility. So it makes diversification really, really important. So there's a few ways that we can solve diversification as a problem, right? What would be your first solution in terms of getting better diversification?
I mean, the first place and the biggest bang for the buck is you need asset class diversification, right? So if you look about the long run, you know, stocks and bonds are negatively correlated. So you know, running any kind of portfolio, you would get immediate benefit by throwing in some other asset classes, just something as simple as some fixed income, some bonds in there. Even if it's a minimal amount, like you can see an 80% equity portfolio with 20% bond is a more efficient portfolio, again, than one that's 100% in equity, because you already get that 20% diversification when you need it. And so it's a better on a risk-adjusted return, if I can throw that term, and from that standpoint, right? I think I'd like today to get down to the stock level. So when you get down to, okay, I need to own equities. Now, what does diversification means? Well, for me, it means, well, we know that diversification benefit grows with the number of stocks, but if you believe in stock picking, as we do, then you want also to not dilute the value of what you do in stock picking, right? So this is where there's a delicate balance between, well, do I want to own 125 stocks? Well, we don't. Do I want to own 25 stocks or less or more, right? So what is the right level of diversification that maintains, you know, that value, that alpha that you're trying to generate?
Right. So you can overdo diversification and turn it to diversification, like Peter Lynch talks about.
Yeah.
And because the more stocks you own, the more you actually replicate the market. And so you can't outperform the market if you own everything. So yeah, you know, at some point there's a sweet spot, and getting down to that is really, really important. Another big thing about diversification is we have this really this scenario where you have converging correlations, which just means that everything tends to move together when the markets get really volatile. So when you need diversification the most, you don't get it because there's this converging correlation. So timing is still important, even if you have the best diversification in the world. So one of the, you know, kind of the three things I think about for correlation as a solution would be, number one, first you want to look for statistical non-correlation. So that's a good starting point. You can, if you have statistical non-correlation, which means the actual stats show lower correlation, that's a good starting point that maybe you have something that will stay that way, that will tend to have lower correlation in the future. But it's not enough just to have statistical non-correlation. You also need to have fundamental drivers that are different. So that's something that you look at a lot, JP, I look a lot at. Can you explain a little bit, just, you know, from your perspective, fundamental drivers and how they're different, and how would we differentiate that? What is a fundamental driver and what makes it be, you know, how do we know they're different?
Yeah, and I'll start by just chiming in on something you said that is pretty important, is about if you look at historical correlation, right? If you look at the last 10 years, we only have one market that we're looking at, and you might be underestimating risk. So something we do, and I think is important to consider, is that you want to stress test your portfolio, right? To that point where when there is a shock, like we have seen, correlations, you know, converge, go upward, right? So when you need that great diversification, you don't get it. So you want to know what's going to happen. And it's the process of what we call stress testing. So we, you know, we like to do this. Like you say, well, what happened if I think my stocks are correlated at 0.7, right? What happened if they go to 0.8, right? So you may be oversizing things. So that's a very important point, right? Just from a portfolio construction perspective. Besides the statistical correlation numbers, what we look at is when you look at the stocks, that individual names in your portfolio, to look at what's driving those those stocks, right? Let's take a very, very basic example that everybody should understand. Let's say, for example, you have an airline and an oil and gas company, let's say Exxon, right? Well, they get affected very differently from an oil price. So we have an oil shock right now. That might be helpful for airlines, putting aside, of course, the effect on travel right now. But as an input cost, which is a very large portion of the cost of an airline, oil and gas going down is a good thing to margins. While somebody like Exxon gets negatively affected as they can't move their oil, right?
When I think about fundamental drivers, I think about spreadsheets. And the reason why, you know, one of my first jobs I had was a analyst intern for a publicly traded company. And my boss at that time was a CFO of a division of Coca-Cola. He really knew corporate finance, right? And I was working with a bunch of CPAs, and all we were doing was modeling. And that was actually before Excel was in existence. I'm dating myself. We used Lotus 1, 2, 3, lots of macros, and we used these big mainframes to calculate things. Anyway, I learned the concept of input, process, and output. So, and drivers are the inputs to the financial model. Like what determines revenue, costs, you know, your revenue, your costs, and then your assets and your liabilities. So, so the revenues could be the number of units, the demand, and then you know what the pricing is. Your cost could be what your input costs are. Could be many different things. You know what's happening with your customers, your suppliers, all of those drivers. So any of those inputs that would go into a financial model that hopefully most analysts on Wall Street are using in their models, those are the drivers. If they're all the same, then you're going to have more correlation in the earnings, which will ultimately show in the price. Because sometimes you could have statistical correlation, but it's spurious correlation, and it will not stay that way. So it's really important to have those inputs that go into those models that drive that business be different. One of the things I wanted to let everybody know is that we're going to provide in the show notes some links for you that are going to give you tips on diversifying your portfolio. And we're also going to, I wrote a chapter in a book on risk management years ago. It was published by John Wiley. And the chapter is called Converging Correlation and Market Shocks. And if you just email us at info@wealthnetinvest.com, and we'll leave that in the show notes, we'll send you a copy of that, a PDF of that chapter. It really explains the phenomenon and how it works. I mean, what other closing remarks do you have about diversification? We know it's important, but we know it's not everything, but we also know that people are not necessarily doing it correctly.
Well, I think we talked about two levels of diversification, right? So one is the portfolio level, asset class level. So make sure that we take advantage of everything that you can, right? So throw in uncorrelated assets. Like right now we have, you know, things like gold that are doing extremely well when maybe in times of hardship.
All right. Well, thanks a lot for listening. Be sure to subscribe to our YouTube, and to get a hold of us, if you want to give us a call, you can always go to our website, wealthnetinvest.com, and happy trading and investing, everybody.